Cobbling together a deposit for home buyers and indeed investors for property can be tricky. But with me today is Simon Heilpern from the Deposit Doctor with an interesting alternative. Simon, good to have you with us today.
Lovely to be here, Jenny. Thank you.
So let's start with you explaining what exactly is the Deposit Doctor.
Deposit Doctor is a very simple scheme. What it does, it delays the payment of your deposit from exchange contracts to completion. The biggest problem in the country today is people buying property. 70% of people want to own their own property, and large numbers can't. And therefore what we're trying to do is lower the barriers of entry so it is easier to buy property. You still must be able to afford it. But what it means is, rather than putting down your deposit today, you put it down on completion.
So is this a similar model to, say, a bridging loan?
No, because it's not a loan. It is a cash flow advantage. It's really important. This is not lending. This is buying a bond from an A-rated insurance company, and they give you a piece of paper which says, I promise to pay the bearer the sum of your deposit, exactly the same as cash, save the usual cash we use at the Bank of England on the note. This has an insurance company on the note. But what it means is that you don't need to pay your deposit until completion.
So who issues these bonds?
It's issued by an Australian insurer, CBL, with whom we've got a relationship. They've been operating in Australia and New Zealand for 20 years. Standard practice over there. Madness we don't do it over here. And therefore we decided to introduce it into the UK.
Well, that was going to be my next question, because obviously it sounds quite revolutionary, but it does have a history over in Australia. So how does it work there? How do people respond to it there?
Well, people respond very well, and it is more or less a standard form of purchase. So rather than coming up with a full cash deposit at day one, they tend to pay it on completion. Now, there are different parties who would have come up with different solutions, but it is a very common approach over there, and it seems a very sensible thing for us to do over here too.
So it's certainly tried and tested then. So what kind of customers would it really benefit, would you say?
Well, it benefits virtually any customer. The ones probably most are those where there's a delayed completion. So if you're buying off plan, or you've got a delayed completion, then it's a very efficient way of managing your cash between the exchange contracts and completion. The cost of these bonds is only at 3 to 3.5% currently of their face value, which means there's really quite a low premium, but it means that if you've got your £10,000–20,000, whatever the deposit sum is or more, and you've got other expenses in the 1, 2, 3, 4, 6 months up to completion, you can manage your cash flow, provided that on completion you have the full amount.
And when it comes to due diligence, what sort of checks are carried out before issuing the bond?
It's actually very simple, is that we all go off and get a mortgage offer or an offer of finance. And there are two things that are required on the online form, which is remarkably easy to fill in within 10 minutes or so. One is a national insurance number for UK residents, and the other is your offer of finance or a mortgage offer.
So what sort of time frame were you looking at? How long can you get these bonds for, and when do you need to pay it?
Okay, well, the bonds are available for a period up to 2 years in terms of standard terms. One of the interesting things about the bond is it's available for 20%. So if you're a vendor, it's fantastic, because rather than taking a 10% deposit, you take a 20% deposit. And because the cost of the premium is so low, from the purchaser's point of view, it's easy to offer the 20%. And just imagine, if you're negotiating to buy a property and you're offering a 20% deposit, does that give you more negotiating power? Are you going to buy the property at a lower price? Those kind of issues arise. And
is this model targeted at purely the residential market?
Well, there are a couple of things actually, just in terms of what I was previously saying. On the site, we're up to £2 million, up to 20% for 2 years. We can write bespoke business for variations of that. So if you're an overseas resident, if it's commercial property, if it's more than £2 million, or there's a variation, the site is set up so there are emails and telephone numbers that you can use so that we can write bespoke business. And we and the insurance company are very happy to write bespoke business. So the core is £2 million, 20%, 2 years, UK residents. If you fall outside of that, Don't be put off, because we can still write a policy for you.
So for those watching this interview and think this sounds really interesting, what's the process? How do they go about it?
Process is straightforward and simple. Depositdoctor.com. Very simple explain the video when you open up, 73 seconds, nice and short and crisp to explain the concept again. And then you go through to the apply. It tells you what the premiums are going to be, online form. 10 to 15 minutes later, assume you've got your information together, you send that off, and almost by return, it comes back and you have your bond.
And anything applicants need to actually really be aware of?
Well, they will need to have a mortgage offer or offer of finance. So that is the first thing. The second thing is they need to make sure their vendor is happy with this. Now, as it happens, this business I'm doing with my brother, who's a property and finance lawyer. I've been in property for most of my working career. So between us, we've got many decades of experience creating solutions for clients for complicated investment products, simple buys and purchases, etc. So we have written bespoke clauses for lawyers so that they can easily amend the contract to include Deposit Doctor. And those are on the site.
So finally, let's talk about fees. If somebody wants to go down this route, is this a more expensive way than managing to find the deposit up front, or how does that work?
Well, 3 to 3.5% is the current cost, which is pretty modest. If you break a contract to take your monies off deposit too soon, you lose interest. If you've got shares, you may lose a dividend. It may be inconvenient. You may not want to. If your property's tied up, if your money's tied up in another property, bank of mum and dad, an alternative property, you may have a fixed term period, and you've got heavy penalties to pay if you end that early. So why not use this to bridge those gaps?
And how does this model work for developers?
Well, for developers, it's a wonderful solution, particularly as the market gets more difficult. It lowers the barriers of entry, so it's easier for buyers to say yes. With all the inquiries for contract and the contract ready and so on and so forth, it means that if the buyer's not ready to put down their full deposit, for whatever reason tied up in other investments or whatever, they can take out a bond, and then the developer can exchange contracts virtually there and then. So the two main advantages. One is speed, because it means you can close the contract when someone comes through the door. And the second is that you can take 10% or indeed 20% of the deposit immediately. And therefore, from the developer's point of view, they have 20% of the gross development value paid at exchange of contracts by means of the Deposit Doctor bond. Those bonds, in turn, are capable of being geared with banks to the tune of in the order of 70%, and we'll take developers through banks with whom we've had those discussions. But it is closing those deals that matters, getting them done as quickly and as efficiently as possible with 20% deposits.
So Simon, say I'm looking to buy a £500,000 property and I need 10% deposit. Now I have that money, or I certainly can get it together. Why should I go down the Deposit Doctor route? Okay,
this is all about organisation, organising your finances. At a very small cost of £1,500 or thereabouts, 3 to 3.5% of the deposit money is being 50,000 in this case. You then have the flexibility to manage your cash flows. So suppose you are buying off plan, and suppose your property is going to be ready in 6 months' time, but during that period, having put all of your £50,000 into paying the deposit, you then have little flexibility for your holidays, usual expenditure, legal costs, furnishings, etc. And it is really hard for you to manage. So therefore, by buying the bond, you then have your cash sitting there, and the float will go up and down, but you know and you're confident because of your job and your prospects and bonuses and maybe family, parents, etc., that you can afford 50,000 on completion. You manage it. And after all, the reason why you have an enjoyable life rather than not is because you're organised and you manage your finances appropriately. And this is a very useful tool to do just that.
And these bonds would really come into their own when it comes to buying off plan, where you're not going to be able to move into the property straight away anyway, I imagine.
Well, yes, and we've got a minimum cost of the bonds. Minimum cost is £500. So one questions whether that's economic or not. But in most cases, it will be. But if your delay is anything more than a few months, then it certainly makes sense. In practice, what tends to happen is the public tends to get their deposit monies ready, probably a couple of months before they go out and start looking, and then they look, and then they wait till they get to exchange contracts, and then they complete. They've probably been sitting on the deposit monies for 6 months. And just imagine if you'd have started your search 6 months earlier, particularly in a rising market, you might have secured a much better deal. There's lots of reasons for using it, but it is a cash flow fix, and it's been used for Australia and New Zealand for 20 years. So why aren't we doing it? It's madness.
Simon, thank you. Really interesting.